Why You Need a Tax Planner with Larry Weinstein, episode 254. Are you ready to make your law firm a profit-generating machine that will free up your time and skyrocket your impact? With more than 2 decades of business growth experience and having proven that you can be successful while prioritizing your family and your impact, introducing the Profit with Law podcast. I am your host, the creator of the Firm Differentiator 10X Effect, Moshe Amsel. Well, hello and welcome to another amazing guest interview here on the Profit with Law podcast. I'm your host, Moshe Amsel, and I'm excited about our guest today. Why? Because we're in the same business. And it's always good to have somebody who you understand what they're doing, you understand what they're going through, because you can easily tee up the conversation and give them the softballs to really bring the most information possible for the conversation. And I'm an accountant, and I've got Larry Weinstein, a CPA for lawyers is what he calls himself, right? So we've got him on the podcast. Now, let me just give you the official bio. Larry Weinstein is a CPA, also known as a CPA for lawyers, and a tax terminator. Larry's practice is concentrated in the area of proactive, strategic tax minimization and tax preparation. Larry works with law practice owners around the country who are interested in implementing a tax strategy to legally reduce the income taxes they pay. Larry is the developer of the strategic tax minimization process and lives in Houston, Texas. Also an author of at least one book, but I think multiple books. We'll find out when we get him on here, and we're going to bring him on in just a moment. But before we have a conversation with Larry and we dive into this thing that people hate to talk about, which is taxes, but I'm going to tell you one thing, and that is the biggest expense in your business. It's not technically an expense, but the biggest expense in your business is your tax bill. When you turn around and you look at your P&L, your marketing might be 10% of your revenue. Your personnel might be 10, 15% of your revenue. Your tax bill might be upwards of 50% of your profit. So you want to make sure that you get a handle on that. And that's why you want to pay attention to this conversation. Before we jump in, we're going to take a quick moment and share some words from our sponsors. Finding amazing employees is the toughest job for any business, and especially for a law firm. You deserve to be the law firm owner you've always wanted to be, but you can't get there without a great team. Get Staffed Up helps you build your all-star team by staffing your law firm with incredible full-time offshore virtual assistants. Work with Get Staffed Up to save money and your biggest resource, time, while they find you the best English-speaking VAs in the world. Hashtag delegate your way to freedom. To learn more, go to profitwithlaw.com/get staffed up. profitwithlaw.com/get staffed up. Thanks to our sponsor, Smith AI. Smith AI is a superior virtual receptionist service for small businesses. They specialize in working with solo and small law firms. I discovered Smith AI a couple of years ago and was blown away by the range of services, which are available at a cost any attorney, even those of you in the smallest solo practice, can afford. Their friendly receptionists respond to potential clients in English or Spanish, screen and schedule new leads, and even take payment for consults. The best part is, they don't just handle these conversations by phone. They also have live agents and chatbots capturing leads on websites and via text message. If there's one growth hack to your practice, this is it. Smith's friendly gatekeepers can staff your front lines. They'll capture new leads while you work uninterrupted. You can finally have the peace of mind that while you're working, you're not missing out on future work. Plans start at just $210 a month for calls and $140 a month for chats. They even offer a totally free chatbot, so there's no excuse. Try Smith AI today and see for yourself why attorneys like Justin Nickel in Colorado say Smith AI receptionists are the secret to business growth and client happiness. Smith AI offers a free trial, and podcast listeners can get an extra $100 discount with promo code ProfitLaw100. That's ProfitLaw100. Sign up and learn more at www.smith.ai. Trust me when I say, don't let another day go by. Try Smith AI. And we are back. Larry, welcome to the show.
Well, thanks, Moshe. Thank you so much for having me on. It's an honor to be here.
and it's my absolute pleasure to have you here. We had the pleasure of having you speak at the Law Firm Growth Summit in 2021, and it was truly an incredible experience for everyone involved. And your topic was one that people really enjoyed. So I'm happy to have you here on the podcast as well, share you with people who might have missed you at that moment, and perhaps also to share some more words of wisdom that you might have not covered in that session. So I want to jump in real quick and just get a quick backstory, who you are, how you got involved with lawyers. Give me the broad strokes so people know who they're listening to.
Well, like you said, I'm Larry Weinstein, CPA for about 32 years or so. I work not exclusively with lawyers, but I work with a lot of lawyers. I've known lawyers for a while. I actually kind of started meeting a lot of lawyers through Ben Glass. I started hanging out with Ben Glass and his group of people, not to get clients back in 2006, but because I wanted to study good, smart, effective, ethical marketing. And I met some great lawyers along the way and kind of know some of the issues that they deal with and in taxes and things like that. So that's kind of how I got started. And as I like to say, I'm a 32-year overnight success, right?
Yeah. And it's funny, this conversation came up today. I interviewed Melissa Shanahan this morning. I don't know whether your interviews will be released back to back, but hopefully hers was released or will be released, but it's the same day that I'm recording this. And I had this exact conversation with her, and it wasn't behind the microphone. It was after we finished. And I said, when you look at somebody who's successful, they look like an overnight success to the layperson. And when you actually have a conversation with them, you find out that they're an overnight success 10 years in the making. So
that's right.
You apparently hold the world record at 32, but
it didn't take quite that long.
It really is, it really is the journey of business. Is we try to take shortcuts. We try to circumvent the system that we need to go through in order to build success. And then we realize, we've been spinning our wheels trying to do something that really wasn't necessary. And then we slow down and we take a more methodical approach, and suddenly we start to see little traction, little by little, that train starts to get going. And before we know it, we're at top speed. And my first question to you, because we're going to be talking about tax, and I know that you're involved in tax planning, when in the business journey should a business owner start paying attention to tax planning strategies?
Oh, that's a loaded question. Of course, I would have to say kind of from the beginning, because it all starts with the entity that you select. Because, and I don't know if our listeners know, but back it was at the end of very end of 2017, they passed a change to the tax law starting in 2018, 2019, et cetera. And one of those was the qualified business income deduction. That's a really nice, sweet deduction for most lawyers and law practices. But it's only for pass-through entities. So generally speaking, you want to be a pass-through entity, such as a partnership, could be a sole proprietorship, could be an S corporation. Really, the only one that would not qualify for would be a C corporation, which is a separate entity that is they file their own taxes and they pay their own taxes. So from that standpoint, selecting the right entity would be good. Now, admittedly, a lot of lawyers, when they start their practices, they're probably not going to, hopefully they're profitable from the beginning. Maybe they won't make tons and tons of money at the very beginning, but I think that you need to be thinking ahead as to what you need to put in place in terms of some of the strategies. Could be fringe benefit, asset, family strategies, retirement strategies. You need to be looking ahead. And I think that even if you're not ready to implement some of those things, at least kind of know where you're going to be going. If you're not ready to do those things, just know that those things are out there. And one of the things I really wanted to leave your listeners with today is really kind of a change of mindset. And I was interviewed by Melissa recently for her Velocity Works. And that's the one thing I wanted to get across to the people that were on the call, is basically to change their mindset, to let them know that tax planning, strategic tax minimization is legal and it is possible. Because there's a lot of people think that, what is the old joke? How much did you make last year? Send it in. Like that's the tax planning. So,
right. No. You know what's funny is, and I want to get back to tax planning, but real quick, I was in a tax professionals Facebook group, right? And somebody was asking a question about how to strategically help a specific client. They painted the scenario, And I told them, I said, well, the scenario you painted, the client has a 6-year-old child and they're a business owner. I said, well, they should employ their child. They should pay their child a meaningful wage for what they're doing. Obviously, they need to keep track of their time. And when the money comes in, they can either choose to now deploy that to the household expenses that the child is benefiting from. So it's the child paying for their expenses, or start a Roth IRA for their kid because they have earned wages, and they would avoid Social Security tax. They would avoid income tax for the money that this child is earning. And I got kicked out of the group because the moderator of the group said that it was one of these scam ideas that wasn't legitimate. And what's funny is that then I sent him, I sent him case law, and I said, look, this, there's a documented case of I think it's actually 7 years old, but they started at 6 years old. So there's the IRS did not refute, the tax court did not refute the age of the child in question in that case. And that's the basis we have for how young you can employ your children in your business to start to shield some of the income and pass it to your child, or bring it back into the household tax free. And what's funny is this is a tax professionals group.
Yeah.
And even tax professionals don't like, there are tax professionals out there who just are not well versed in the law, and therefore they don't make good decisions for their clients because they don't even have the information that they need to provide the right guidance to their clients.
Yeah. Unfortunately, possibly fortunately for me, myself and yourself, is that there's a lot of people out there. I like to call them fully depreciated Fred. Okay. All they do is they're just interested in putting the right numbers in the right boxes, making sure the tax return is timely filed, and calling it a day, and getting that off their desk and moving on to the next one. They're just grinding them out, but they're not looking ahead. I mean, that's really being reactive. That's the thing that CPAs and accountants have historically done, is they basically record history. With what we're speaking about, it's proactive, it's thinking ahead, it's structuring our affairs so that we can legally lower our taxes. And by the way, there's nothing illegal about that. I mean, there's lots of case law about that. There's a Judge Learned Hand from the 30s who actually, there's a famous quote from him. So it's totally legal to do so. And I would strongly suggest that people look into that. There's just a lot of our fellow professionals that don't understand that. And then the one thing, you started to bring that up, we're kind of getting ahead on strategies here, but yeah, employing a family member is a great idea. And the law there was a court case, and it was a 7-year-old. They said 7 years old was, I usually try to wait until they're like maybe 9 or 10 so they can do something meaningful. So for those of you out there, you have to pay, to clarify what Moshe has said, you need to pay them a meaningful wage. I would say a reasonable wage. With any of the strategies that we might talk about, everything is basically dictated by ordinary, necessary, and reasonable. Okay, so there's a lot of times when we talk about specific deductions, they may not exactly be in the code, but they have to be ordinary, necessary, and reasonable. And the point that I want to make is, if you've got a 7-year-old and maybe it's legal to pay them, but what are you going to pay them, and what can they legally do for your business? Can they sweep the office? Can they help stuff envelopes?
They can shred paper. They can
shred paper.
They can file. They can put papers into files.
That's right.
and in today's day and age, I mean, they can operate your YouTube channel. I mean, the kids are smart.
Yeah. When they get older, I'd say, yeah, maybe they can help manage your social media. They can manage your website, whatever it is that they could legally do. And one of the beautiful things and I'll go ahead and expand upon this, is the standard deduction now. And the standard deduction for each individual is, I think it's 12,400. I think it started at 12,000. And what they did is they combined the standard deduction and the personal exemption. So what that really means is your children can file their own tax return. They can earn $12,400 if you choose to pay them that much, and they won't pay any federal income tax on that money. So basically, it's taking off of your tax return the $12,400 at whatever your tax rate is. Call it 35%, And for them, they've got a tax rate of 0%. So you save 12,400 times 35%. Well, 12,000 times 30% is $3,600.
Right.
So
And if you're a Schedule C filer, you also avoid the Social Security, the FICA tax. So
that is
you save
correct.
another 15.3%. However, if you're an S Corp, they have to be on payroll. They actually you would pay that 15.3%. So it really depends on your entity. But the standard deduction in 2021 is going up. The tax code that changed the deduction also made it that it goes up with inflation. So this year it's going to be $12,550.
Yeah,
so you get an extra $150 that you can pass through tax free to your child. But even if you exceed that amount, right now, hopefully you're not doing slave labor, and if you're paying them a reasonable wage of what it would cost somebody else to do that work, and they're not working full time, hopefully you're not exceeding that amount anyway, because that would be unfair to your child and missing out on their childhood. But you could go over that. The next threshold is 10% tax.
That's
so
right.
if you're in the 36% bracket and you can pay 10% on that income, that's a significant savings as well.
I think the next $10,000, if I'm not mistaken, might be taxed at 10%. So yes. Yep. So if you go over, it just really depends on how old they are and what they're doing. And I guess the other thing that I would kind of just clarify for our listeners is I call it the straight face, the test. If you ever got questioned, one, you have to document what your child did for you. You document it. What's the job description? Here's the timesheets of what they did. You have to legitimately write them a payroll check, and keep it all very clean. But at the end of the day, the straight face, if you ever got questioned by an auditor, could you keep a straight face and saying my 6-year-old child was managing my Facebook account and keeping my server up and running? Probably not. But there was something that they could do, that they could legally do and get paid for.
Yeah, well, my 5-year-old he's already is shredding papers for me. And although I'm a paperless firm, I still have clients who insist on sending papers here and, producing papers. So at the end of tax season, there's a whole stack of papers that need to be shredded, and that keeps them busy for an hour a day for a few weeks at least, shredding papers. So I'm not saying that I take a tax deduction is 5 years old. I'm not messing around with, with any issues there. But the reality is that if at 5 they could be shredding papers, at 7 there's definitely stuff that they could be doing. But I don't want to get hung up on this, because I want to make sure that you get an opportunity to talk about other tax strategies. So the first thing that you established, I just want to reiterate, is that there's a difference between tax prep and tax planning. And the biggest difference is that tax preparation is what we typically think of our accountant, right? I go to them in January, February, between February and April, and I give them all the information. They ask me questions and they produce a tax return, and I find out whether I owe money, whether I'm getting money back. What happens after they file your tax return all the way until January of the next year? What is your relationship with that person? If there is no relationship and that was it, you have a tax preparer. Right. And a tax preparer is nothing more than just somebody who is doing the monkey work, who is basically filling in boxes, checking boxes, and sending a return in. Now, there are tax preparers who leave money on the table even in that part of the job. One of the examples that I can give is the home office deduction. I can't tell you how many clients have come to me where the home office deduction, the tax preparer took the simplified method and left thousands of dollars of deduction on the table.
Or they didn't want to take it because they said, well, that's a red flag.
You might get audited.
Red flag. You're going to get audited.
You might get audited. Exactly.
No.
So, but the point is that all the work that you can do to avoid taxes happens during the year. There is very little that can happen from January to April that will change your tax situation. A little bit of retirement contribution. That's it. Mm-hmm. Right. So you need to align yourself with a tax planner, somebody who is going to have your best interests at heart, who understands your business, who understands your family situation, understands your motivation, what you want, and is able to take those pieces together and create a plan and a strategy for you to pay as little taxes as possible, while legally, at the same time growing your wealth and your assets in the way you want to. So, Larry, I'm going to tee this up for you. I know that you have a system you use to walk people through this process, this planning process. So what is that?
Well, we start out, like I said, we look at entity. I call it the Larry six pack. And the Larry six pack would be obviously the entity. We look at QBI strategies. We would look at asset strategies, family strategies, which we started talking about, fringe benefit strategies, and retirement strategies. Those are the 6 things that we look at. So by the time it comes, if we've done the work on the front end doing the strategic tax minimization, by the time we get to do the tax return, I already pretty much know what your taxes are going to be, because we put these we put these strategies into place, and I know what your income has been along the way. We've been meeting, say, on a quarterly basis, and I make sure that you've put in the appropriate amount of money for your estimated tax payment. So we're going to be really close. At the end of the day, I don't want you to be significantly underpaid. By the same turn of a coin, I don't think you should be significantly overpaid, because I think the money belongs in your, I don't think you should be loaning the government money, because ostensibly you have more money than the government. But that's the whole process. The other point that I really wanted to make, one of my pet peeves, and you know this, you might not have thought about it this way. One of the things that you hear lay people talk all the time, and you even hear some tax professionals talk about it. They talk in terms of tax loopholes. Have you ever heard the term tax loopholes? I'm sure that you have.
Yep.
I personally do not think there's such a thing as a tax loophole, because I think that a tax loophole suggests that there's a negative connotation. In other words, that somehow the government has made a mistake, and somehow we figured out a mistake in the tax code and we're exploiting that mistake. At the end of the day, mistakes, they for sure they do happen, but they're usually corrected pretty quickly with what they call Technical Corrections Act. So everything that we're talking about, all of these strategies, they're built into the tax code, and they've been there for a while, and they're there intentional, because the IRS wants you to. They're either trying to affect your behavior, or they're trying to change your behavior.
Right. It's not the IRS, right? It's Congress, right?
So it's Congress.
So Congress has passed law that is written into the tax code that is there to drive behavior. For example,
that's right.
There is a $7,500 EV credit. You can buy an electric vehicle as long as it's with a manufacturer that hasn't produced 200,000 of those vehicles yet. You can buy an electric vehicle with a manufacturer and get $7,500 off your tax bill just for doing that. Why? Because they want to push their agenda of moving us away from fossil fuels. And there's even talk in the potentially in the new act, which might have been passed by the time that we air this episode. But at this point, nothing has even been proposed yet. But there's been talk about this new Biden plan, that the infrastructure plan that's going to have some significant dollars in EV, which is going to potentially lift that 200,000 car restriction, and potentially even increase the credit to $10,000, which is what they're bouncing around and talking about. And that's just one example where they're trying to drive our behavior. Real estate has massive tax benefits, because the government decided that it's in their best interest to encourage us to own property. And that's why those things are built into the code.
Finding amazing employees is the toughest job for any business, and especially for a law firm. You deserve to be the law firm owner you've always wanted to be, but you can't get there without a great team. Get Staffed Up helps you build your all-star team by staffing your law firm with incredible full-time offshore virtual assistants. Work with Get Staffed Up to save money and your biggest resource, time, while they find you the best English-speaking VAs in the world. Hashtag delegate your way to freedom. To learn more, go to profitwithlaw.com/get staffed up. profitwithlaw.com/get staffed up. Thanks to our sponsor, Smith AI. Smith AI is a superior virtual receptionist service for small businesses. They specialize in working with solo and small law firms. I discovered Smith AI a couple of years ago and was blown away by the range of services, which are available at a cost any attorney, even those of you in the smallest solo practice, can afford. Their friendly receptionists respond to potential clients in English or Spanish, screen and schedule new leads, and even take payment for consults. The best part is, they don't just handle these conversations by phone. They also have live agents and chatbots capturing leads on websites and via text message. If there's one growth hack to your practice, this is it. Smith's friendly gatekeepers can staff your front lines. They'll capture new leads while you work uninterrupted. You can finally have the peace of mind that while you're working, you're not missing out on future work. Plans start at just $210 a month for calls and $140 a month for chats. They even offer a totally free chatbot, so there's no excuse. Try Smith AI today and see for yourself why attorneys like Justy Nickel in Colorado say Smith AI receptionists are the secret to business growth and client happiness. Smith AI offers a free trial, and podcast listeners can get an extra $100 discount with promo code ProfitLaw100. That's ProfitLaw100. Sign up and learn more at www.smith.ai. Trust me when I say, don't let another day go by. Try Smith AI.
That's why you can deduct mortgage interest and real estate taxes. They want people to be charitable and help out our fellow man. That's why they have charitable contributions. Some of the plans are fringe benefit plans that we can provide fringe benefits and get a tax deduction for our employees. The government wants us to provide health care for ourselves and our employees. The government gives us tax breaks for retirement plan. They want us to plan for our own retirement and provide for our own retirement and don't just rely on Social Security. So absolutely that the Congress is really trying to encourage different behaviors. And they do that by the tax breaks that they give us. But I don't think they're loopholes. I agree with you 100%. And I like that you have pointed that out because, I mean, I don't use the word loophole, but I understand exactly where you're coming from, where it does have that negative connotation. I mean, look, the former President Trump stood up in front of the nation in his debate with Hillary Clinton and said, I don't pay any taxes because I'm smart. Right. And there was a lot of lashback from that. But the reality is that he was smart in that he has professionals who are guiding him with his tax strategies. Now, whether there was any illegal behavior or criminal behavior in that, it has yet to become known, but it's certainly feasible and possible for somebody to have a multi-million-dollar empire and pay $0 in taxes. Because there's something called depreciation. And so he's getting massive depreciation on his properties. And that's and by the way, for the listeners, that's a non-cash expenditure. That's an expense that you didn't actually have to pay for.
Right. Well, I mean, in the long term, you pay for it, but you may not have paid for it yet. Right. You may not have paid for it yet. And the other thing is that you could also make some poor decisions along the way. And if you have enough business entities going on and enough things happening, then one poor decision, one, big loss can offset a lot of other income and put you into that situation. So people shouldn't think, if somebody's paying $0 in taxes, or if they're paying very little, that they're doing something illegal or they're doing something wrong. They have strategized and gotten to that point. And one of the things that you mentioned is the in the new tax code, there was a QBI deduction that was implemented to allow pass-through entities to be on the same playing field as a corporation, which got a flat tax of 21%. And that QBI deduction basically says anything you earn, the first 20% doesn't get taxed. The problem is that there are certain professions that have a cliff. They basically, if you earn more than this, you don't get any of that 20% off.
Yep. And for lawyers, because you're referring to specified SSTB, specified service trade or businesses, lawyers, CPAs, doctors, we all have targets on our back. So if your taxable income is greater than $26,000, $426 as a married filing jointly, then you lose the QBI deduction. That's exactly correct. Which in the QBI deduction, qualified business income deduction, I think that they did that for the small business because they reduced and they made a flat tax of 21% on the C corporation. So, what used to be maybe, what was it, 35 or 39%? I don't remember. For the bigger corporations, they kind of leveled the playing field. But we can't give too much away. We can't give you too much.
Right. So it all of a sudden you start to realize, well, hold on a second. If I know beforehand that there's a good chance I'm hitting this number and I'm going to lose 20% discount off of all of my business earnings, then maybe there's something I can do to reduce my income a little bit, stay under that radar, and actually get that credit back and save a lot of money on taxes. That happens with the planning, right?
That is an excellent point, because I always lead off. I'll talk to people about the qualified business income deduction, and it's a very nice deduction. It's 20% of your net profit effectively. And that's a wonderful thing. And then times whatever your tax rate is. However, it might be that you're making too much money. Your taxable income's too high, so you don't qualify for the qualified business income deduction. But that's not the only deduction. That's not the only type of planning. Remember, I called it the Larry six-pack. That's one of 6. So I've certainly had people come to me, and when they came in to see me, they did not qualify for the qualified business income. That doesn't mean that there were other strategies that we could put into place to reduce their taxable income. I've seen situations, if you're making, let's just pull a number out of there. If you're making $1 million taxable income, I probably am not going to be able to reduce your taxes down to $426,000 of taxable income. So maybe I cannot get you the qualified business income, but maybe you were hovering a little bit above the 426, or maybe a significant amount. And we implemented some of the asset strategies, retirement strategies, fringe benefit strategies, family strategies, all of those things. And now we got your taxable income down. Not only do we save taxes based upon those strategies, but whereby before you didn't qualify for the qualified business income, now that you do. So you got a kind of like a double dip.
Double whammy, right?
Double whammy.
There you go. So, all right. So let's talk about each of these categories. We don't have a lot of time, but I just want to touch on each one so people know what they are. And I know some of our listeners are tax attorneys. We're not telling you anything you don't know. But even tax attorneys who are there defending positions and things like that, if you're not doing tax planning yourself on a regular basis, it might not be a bad idea for you to have a professional to bounce this off of, because they're doing this day in, day out. They know certain strategies that you just might not have thought of yourself, even though you're very familiar with the tax code. So let's go through your Larry six-pack and let's just touch on each one, and let's just give the broad strokes of what kinds of things we're talking about in those.
Gotcha. Yeah. And absolutely, I'm going to go over that, but I mentioned it before. I'll probably mention it before we end. I want everybody to kind of change their mindset that everything that we're talking about here is perfectly legal, and it's something that you really should take the time to, if you don't do it yourself, find somebody that will help you do it. And I'll be glad to help you, but I'm not the only person out there. Whether you do it yourself, whether you read books, go on the internet, change your mindset, because this is all legal. Okay. When we talk about the Larry six-pack, first of all, we talked about qualified business income. That's a beautiful thing. That's 20% of your profit is a deduction. And it's a deduction just like your personal exemption / standard deduction. So that's tax affected. And by the way, there's 2 types of deductions. There's what I would call tax-free, that you could end up tax-free income, and tax-deferred income. Everything we'll talk about, except for the last one, is going to be tax-free, which means you get a deduction for something that you might have already been spending the money for anyway. And if you get to deduct an expense that makes income non-taxable, that's tax-free income. That's what I call it. Okay. So the qualified business income is one of them. And that's very, very tightly tied into the entity, because you have to have the right type of entity. Has to be a pass-through entity. Effectively, it has to be any entity other than a C corporation, which files and pays its own taxes. A sole proprietor, an S corporation, a partnership, those are all pass-through entities. Okay. We already talked about family strategy. That's the third in the Larry six-pack. If you can hire your family and get them to do some work. Now, what we're mostly talking about is maybe hiring your kids. It could be hiring your parents, because remember, if we pay our parents, then and they of course have to legally do something for us, legitimately provide some services and give us some time. But we're taking income off of our tax return and we're putting it on their tax return. And we would think that they would be making less than we are. Maybe not. I don't know. But generally speaking, it wouldn't be so important to hire our spouse, because, and I'll talk about this in a second. If we hire our spouse, we'll get a deduction on our Schedule C or on S corporation income, but we're going to have to pick it up on line 7 as wages. So that doesn't really do anything.
Right. I do want to jump in real quick, because with hiring the spouse, there are certain strategies that would allow you basically to combine your fringe benefits with the spouse, pay, and rather than paying them a wage, you can pay them with benefits, and that's a way to get your health insurance and your health expenses paid for your business.
And I'll talk about that in just a second.
It depends on the size of your business and all of that. What are you signing up for the rest of your staff when you're doing stuff like that?
That's right. So that's family strategies. Generally, I would say you wouldn't hire your spouse, but to kind of flesh out what you just talked about, under fringe benefit strategies, there's a way that you can set up what's called a Section 105 medical expense reimbursement plan. And the medical expense reimbursement plan is euphemistically referred to as a MERP, MERP. The medical expense reimbursement plan is for the benefit of your employees and their spouse. So what you really need, where this works the best, is if you're a sole proprietor and you don't have a lot of other employees, or if you do have employees that they haven't been with you long enough so you can legally exclude them. But remember, the MERP, the medical expense reimbursement plan, is for your employees and their spouses. So Moshe, let's just say you hire your lovely wife into your practice. So this is not for your benefit. This is for the benefit of your employee, your wife, and her spouse. Who's her spouse?
Yep, that's me.
That would be you. So that's the way that you get to write off a medical expenses. It could be health insurance premiums. It could be out-of-pockets and copays and things like that. The beauty of this is your medical insurance, if you know your way around a tax return, your health insurance is deductible for income tax purposes, but it's deductible on what we typically would call page 1. It's an adjustment to income. It has no effect on your Schedule C income. So it doesn't reduce
Schedule C income.
It doesn't reduce the self-employment tax. But when you adopt,
it's also only deductible to 50% of the insurance.
That's right.
So you lose 50% and you pay self-employment tax on it as well.
And you otherwise likely wouldn't be able to deduct it, because if you were to try to itemize your deductions, it would be an itemized deduction. And there's a couple of problems with that. A lot of people now, with the standard deduction for married filing jointly being north of $24,000, they just otherwise are not able to itemize. If they are able to itemize, then the first 7.5% of adjusted gross incomes, which would be, so all of your medical expense, all of your medical premiums, all of your out-of-pockets, they probably don't exceed 7.5%. So it's really hard to itemize. And it's been really hard to itemize your medical expenses for a very long time, because for that to happen, you had to have some pretty hellacious, that's a Texas term, that's a whole bunch. You have to have a hellacious medical expenses and really have relatively low income. And if that happens, you're kind of in a world of hurt anyway, where you had a lot of medical expenses and not much income. So yeah, that's why this medical expense reimbursement plan, the MERP, the Section 105, is so important, because you can get a deduction on Schedule C and deduct 100% of your medical insurance premiums and 100% of your out-of-pockets and copays and things like that.
And again, the name of the game is to try to claim expenses you're already paying for. You already are paying for your health insurance. You're already paying for the out-of-pocket medical expenses, the copays, the drugs, the anything that's not covered under your plan, and you're paying out of pocket. all of that is being paid with after-tax money. And now you can use it, you can pay it with money from the business, which is pre-tax. And not only you're saving on the income tax, but you're saving on the self-employment tax too. Really, really powerful stuff.
Yeah, generally speaking, that's correct. What we're really talking about here, and for the most part, is we're using money that we're already spending. I've had a friend and colleague say, it's taking money from my left front pocket of my pants and putting it in my right pocket. It's the same money, but I'm just reclassifying it. I'm legally taking advantage of the tax code and legally reducing my taxes. Remember, there's nothing illegal or nefarious about this. Everything is totally legal.
Absolutely. All right. Keep going down the
Keep
six
going.
pack.
Another strategy, we talked about fringe benefit. Another strategy would be asset strategies. Now, asset strategies, mostly what we're talking about, I mean, just the easy part of it is we can buy assets and we can buy them before the end of the year. We don't even have to pay for them. We can buy them on a note. We can buy them on a credit card and not having even paid for them. But rather than capitalizing the asset, and let's use a number that we can understand. Let's just say you bought something for $10,000. Generally, we would capitalize that as a fixed asset on the balance sheet. And let's say it's a 5-year asset. We would basically depreciate that $2,000 a year on straight line depreciation. So we would get a deduction of $2,000. Well, there's something called a Section 179 immediate expense election that would allow us to take that $10,000 directly against our, as an expense directly against our income. So rather than getting a $2,000 deduction, we get a $10,000 deduction. Now, once again, we're deducting money that we're already spending. We have to kind of keep that in mind. Okay, so that really, what I'm really pointing to here is, did we really need that asset? Okay, well, maybe it was a desk or a computer and we really needed it. Could we have waited until the beginning or the middle of next year and bought it? Yeah, we could have, but maybe we need to buy it and use it now and get the tax deduction. There's a saying from a famous, it might have been Wall Street with Michael Douglas and Charlie Sheen. How many yachts can you water ski behind, right? So what I'm really saying is, don't just be buying assets just to be buying assets. But if you need them, and you know that you're going to need them, maybe you can accelerate the purchase into the current year and get a current year deduction for it. So that's an asset strategy.
Larry, what do you count in this asset strategy column? Is that where you put the home office deduction? Because I'm not really sure where you classify that, but definitely, purchasing a car, falls into this.
It could be that. I think I would probably put fringe home office deduction under maybe fringe benefit strategy, probably. Okay. But yeah, on that one, there's no
doesn't fit into the six pack, but it's there.
Yeah, it's there. It's not you don't have to worry about anti-discrimination, because like with the fringe benefits, you just have to be careful that you're not you're legally discriminating against your other employees. You're legally not covering them, but you're not like you've got a bunch of employees and you're not treating them the same. The IRS doesn't really take too kindly to that. Okay.
Right. So there's also nothing wrong with passing this fringe benefit to your employees if it's something you want to do as a business owner, right?
Absolutely.
And the more that you give your employees, it doesn't cost you as much as you feel like it costs you. Because if I pay my employees this fringe benefit and I'm paying $500 a month in medical reimbursement to my employees, it's actually only costing me $250 a month.
That's right.
Because I'm saving all those taxes. I'm saving the self-employment tax, I'm saving the income tax, and I'm providing it to them tax-free.
That's right.
So they're getting the tax savings. So I'm helping my employees with it costing me a fraction of what they perceive I'm paying them. So they feel like they're receiving $500, but it really only cost me $250.
That's right. And that's a really good point, because a lot of times, it's like, well, you've got a few employees and you might not be interested in doing this because it might cost you more money, but that's kind of short-sighted on my part. I can't make that decision for somebody. I have to lay it on the table and see if it's something that they want to do, because it's not just about dollars and cents. What you just described is talking about is like, I want to provide for my employees. I want to have a great culture. I want to get the best people. I want to make sure they're happy and they're taking good care of me and the firm and themselves. And I'm taking care of them. and maybe it's not costing me as much as I thought, type of a thing. So yeah, definitely.
Another thing that would fall into the asset category is an office building.
Of
And
course.
if you're renting an office space,
Of course.
why not own the building?
Why not own the building? Yeah, that's kind of advanced, but at the end of the day, you might even think about owning that under a separate entity for
Absolutely.
legal reasons and for also tax reasons.
All right, so keep going.
And then all of those were really what I would call tax-free income, because remember, we took money that we were already spending and we were making it from after tax to pre-tax. So we get a tax deduction. As our expenses went up, our taxable income went down. As our taxable income went down, our tax went down. So that's called tax-free.
I want to jump in for 1 second because I want to highlight this point really quick. If you look at it in the reverse, the tax that you're saving is helping you pay for the thing that you're doing.
Right.
So it's not just, I'm reducing my tax.
You're getting a discount.
It's what someone else is paying for their health insurance. They're paying 100% of that. I'm only paying 50% because I'm getting that tax benefit on the back end of it.
Right. And I guess to build on, to kind of make that point even better, one of the nice things about strategic tax minimization and tax planning is you're able to save money on taxes. And I would suggest that perhaps even gives you a competitive advantage. Okay. And pull out whatever number you want. You save $10,000, $20,000, $30,000 a year. If you're saving that kind of money and you're not having to pay that much in taxes, you're $10,000, $20,000, $30,000 ahead of your competitor who maybe is not doing that. So what are you going to use that money for? One of my favorite things to think about is marketing. Can you spend that money on marketing and get more clients, get better clients? Can you spend it on your people? Could you get a higher caliber of people because you're spending more money? The sky's the limit. Could you buy a bigger, better house? Could you take your family on vacation and have a happy wife, happy life, right? So it basically is a competitive advantage.
Vacation is another advanced strategy that you haven't really talked about, which is, if you plan your vacations around conferences you're going to and things like that, you can essentially have a good portion of your family vacation paid for through business funds, meaning it's a business expense. And there's all kinds of rules, which we're not going to go into today, but there's all kinds of rules.
You're already spending the money.
Yeah, but there's rules about the work days and the weekends, right, and things like that. So you could legitimately go for a 4-day conference and be there for 8 days and have the entire thing be a business expense. Mm-hmm. If you time it right around the calendar. You need to work with a tax planning person to understand what these rules are and schedule it properly so that you get the best bang for your buck.
Right. I would call that fringe benefit. And the Larry six pack.
Yep.
Yes. So
all right. So you have one left, and that's the
last one. Okay. So I just clarified the first 5 that we talked about in the 6-pack are tax-free income, which means you never pay tax on that money. That's tax-free income is the best kind of income. The final strategy in the 6-pack is retirement strategies. Now, retirement is not tax-free income. It potentially could be tax-free. It just really depends upon what your income level is at the time in which you take the money out. But retirement planning, putting money away and getting a deduction, that's tax deferred. We get a tax deduction today. While the money is in the retirement account, we're not paying tax. So we're kicking the can down the road. And depending upon how much money we're earning when we take the money out, we may or may not have to pay any taxes. I've seen some arguments recently, and I can't even go down that road, that, we're at right now, historically, this, Moshe, we're historically at a very, very low tax rate. So if we're at a low tax rate today, and in 10, 20, 30 years, we're at a higher tax rate, did we really do anything? Because we might be paying higher taxes. Then you'd really have to do the calculation. How much more did our money grow because we weren't paying taxes along the way because of the tax deferral?
Right.
But this is another one of those things where Congress wants us to save for our own retirement and to help our employees retire.
Yeah. There's also stuff that you can do in your financial life that's outside of business to effectuate your tax situation. Like investing in real estate and things like that, where you start to look at, okay, I've got all this cash that I brought in, I paid my taxes, I did all that, but now I have cash in the bank and I'm going to go and start investing it. I need to be smart about where I'm putting that money and how I'm getting it to grow so that I am not creating a bigger problem for myself from a tax perspective. And who knows where that's going to go, because there's all kinds of talks about long-term capital gains being changed and those kinds of things. So those rules can change down the road. But for right now, sometimes investing in long-term assets or in real estate can be very, very tax beneficial for you to help offset some of that income.
Absolutely. And that's one of the ways when you talk about capital gains and dividends, qualified dividends that get treated as capital gains. I mean, it's kind of legendary that Warren Buffett, my good friend Warren Buffett, talks about the fact that he actually pays less tax, or I don't know if it's less tax, but
he says he pays a lower percentage,
lower tax rate than his secretary.
Than his secretary.
Because he doesn't have a bunch of ordinary income like wage income and interest income. He's got a lot of dividend income, a lot of qualified dividend income, a lot of capital gains income. If he's invested in real estate, he might have a lot of losses to offset his income. So,
right. So where he might be paying 18% of his income to taxes, although it's a very big number when it's off of billions, right? But 18%, and his secretary is at 23 or 25%. And, she's paying a higher percentage of her money into taxes. Look, we can get into a whole nother conversation about what's fair and what's not fair and all of that. But the bottom line is that the smart people align themselves with somebody who's going to have these conversations throughout the year. And that's really, like, if there's one takeaway from this entire episode, it's that there is so much here to think about that we don't realize. Mm-hmm. One of the things that lawyers tell me all the time is they don't teach business in law school, right? Well, guess what? They don't teach tax planning in law school either. And we can't just put our head in the sand and say, oh, I don't know this, and therefore it doesn't pertain to me. No, it is costing you real money to not be aware and not Absolutely. Be paying attention. And, whether it's with Larry or just with somebody who has that kind of mindset where they're going to spend time with you throughout the year. In my accounting practice, which I don't push a lot on the podcast, we thank goodness we just get the clients that we get. It's not something that I'm really actively pushing to grow, exponentially, but 90% of our clients are paying us every month, because we have an ongoing year-long relationship with them to have these kinds of conversations. We're not interested in just doing a tax preparation at a tax return at the end of the year. That doesn't excite us, because we don't think that we're going to effectuate change in your wealth because of that. But when we're having these conversations all year long, that's where the difference is made. All right, Larry, we're almost out of time. What I want to do is I want to give you an opportunity to share a last nugget with our listeners, and then let them know how they can follow up with you. What's the next step they can take?
Well, thank you. Thank you, Moshe. I guess I'll come back to it. We've talked about it a couple of times. I think that everybody needs to change their mindset. The tax planning is legal. It's something that you should be doing. And as we talked about, I guess I've got another saying that it's a different skill set. It's a different mindset for us as well as professionals to be proactive. And it's like, we want to help you make history. We don't want to just record history. Okay. So I've got another saying that if you're not paying for tax planning, strategic tax planning, you're not getting strategic tax planning. Because if you come to me and I'm just putting numbers in, as I've heard said, and I do this, if I'm putting stupid little numbers in stupid little boxes and making sure it's accurate, that is important. Don't misunderstand. Filing a complete and accurate return is important, but it's not really tax planning. The tax planning has already happened by the time I get to do this. So if you're not paying for tax planning, tax planning is not, oh, you come, you know what? you ought to go open yourself up an IRA. That's really not tax planning. Although that is that's one of the retirement plans. That's not tax planning. And I had a friend and colleague from some time back. He was a photographer, was a photography mentor to me. When I told him about tax planning, he goes, "You mean, should you itemize or just take the standard deduction?" It's like, that is so far off. There's like I call it the Larry six pack. There's so many things to look at, and it's all legal. They're not loopholes. They're perfectly legal things that you can do. And the one takeaway I want your listeners to have is that they really need to look, and I'll be glad to share some resources. I'll be glad to help. But if you do it yourself, or if you use Moshe or anybody, use your own guy, press them. I want to go through a strategic tax planning engagement. See if that's something that they do. Some people do, some people don't.
Right. There's a lot of tax preparers out there that don't even do this, right? It's not in their wheelhouse. They haven't even taken the time to educate themselves on all of the possibilities that you have. And if you go to them and say, "Hey, what kind of retirement account should I get?" They don't even know the difference between a SEP IRA, a simple IRA, and a defined benefit pension plan, right? They're clueless. And you got to know these things if you want to be able to advise somebody on it. So there's a very easy way to find out, which is to ask them for more information. And if they don't know, if they have to get back to you, they can't just tell you off the top of their head, at least what the general criteria is to figure out where you might end up. They're probably not the right person for you. So Larry, how do people get in touch with you if they really enjoyed this episode and they want to take a next step with you?
Well, for those that are interested, my website is the CPAforlawyers.com, thecpaforlawyers.com. And I actually have a resource put together that talks kind of on top, because it's a one pager. It's tax cheat sheet for lawyers.com. That's tax cheat sheet for lawyers.com. And it's a one pager, and it kind of highlights some of the things we talked about today.
Now, folks, if you're out there for a run, or if you're in the shower, or if you're driving, you do not need to stop what you're doing to write these URLs down. We've done that for you. It's in the show notes. It's in the description of your podcast player. Just scroll down, click the link at your convenience, and go check out the stuff that Larry just shared. Check out his website. Check out this free cheat sheet that you can use. And honestly, what we're both here for is to help you succeed in a bigger, better way. This is the Profit with Law podcast. We want you to be more profitable, which means that you're going to have more tax to pay. So we also want you to be smart about your tax situation so that you get to take home more of that profit. We don't want you to give it all to the IRS. We want you to keep it for yourself in a legal manner, without using loopholes, but with using tax strategies that are based on the law that Congress put into effect. And over years, the tax courts have decided that these are all valid and good expenses for you to have for your business that you're perfectly able to take. And to Larry's point early in the conversation is, if something is allowed, if something is legal, do not be afraid of, "Oh my gosh, it's a red flag, I might get audited." If it's clear that this is something that you can take, then take it. If it's a gray area, then you can decide what your risk tolerance is as far as whether you want to be busy with an audit, and you can decide that. But don't not take things, not take deductions, not take advantage of these strategies because you're afraid of an audit. That's a very, very silly place to be. It's almost like I'm afraid to spend money on Google pay-per-click because it might bring me clients, right? And that's really where you need to be willing to have some thick skin. And I know we're talking to lawyers. You guys are amazing. You probably don't have this problem, but I just want to reiterate it. So if you've been enjoying this episode and this is your first time listening to the Profit with Law podcast, please hit the subscribe button so that you get notified every time we release a new episode. We're here every Tuesday and Thursday, at least twice a week. And we are on Tuesdays. It's usually me, just behind the microphone, sharing whatever's on my mind. Thursdays, I have awesome guests like Larry that I share with you, and they bring the heat. They are amazing. And I'm just excited every time that we have these conversations to bring them to you and to share them with you. So make sure to hit the subscribe button. And if you've been listening to us for a while, we'd love it if you left us a rating and review. Just click the button, write a review right there in your podcast player. Leave us some stars, leave a description, because somebody else is coming and doing a drive-by and checking the podcast out. they want to know, is this worth listening to? And it's your words that are going to get them to try it out. So we really appreciate you, our listeners. Stay here, come back Tuesday. We're going to have another great episode for you, and stay profitable. And we're just excited for your success. Take care, enjoy your weekend, and we'll see you on Tuesday.
Thanks, Moshe.
Have you been enjoying the show? We sure hope so. To make sure you never miss an episode, be sure to hit the subscribe button in your podcast player app. Next week, we will be back with more valuable resources and ideas on how to break the mold and take your law firm to the next level.